Well, greetings everybody, and welcome in off of the red carpet for our eighth annual Roundtable Awards. Welcome to the February edition of the Roundtable, and this is the time of year when we do kind of look back a little bit, celebrate a little bit, not to get too wrapped up in the stuff, but we do like to keep track of how well we do, and we have some pretty powerful stuff here to talk about tonight. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, one of the co-sponsors of this event over the last 8 years or so that we've been doing it. And I'm joined here tonight by several of the people that you see on the screen. Everybody on the screen couldn't join us here tonight, but um, everybody that is on that screen has contributed either content or stock selections over the last 8 years, some of them in fairly spectacular fashion. Now, Kim Butcher is here tonight. She's the first one up there on the upper left. We're also joined by Ken Kavula. You just heard Herb Lemkool checking in from his retreat down in Florida. Cy Lynch. So we've got the top four covered up there. Ann Manning from Houston is a reigning champion of years ago. She's been participating on and off over the last few years. Susan Michelik from Wisconsin is the second person in there. Hugh McManus continues to be nomadic and quite busy in his day job. He's unable to join us here tonight, as the same story kind of holds true for Matt Spielman there on the right. And Nick Strategos is in an investment club meeting that probably will be done in time for him to join us by the end of the evening. But again, thanks to all these people for the stuff they've done over the last several years. And let's get into talking about results and some of our favorite ideas right now. Let's get the paperwork out of the way first. We're going to talk about real companies. The reason we do this is to share ideas, and we share those ideas under the umbrella of demonstration, educational demonstration, illustration of the philosophies, methods, and practices of the modern investment club movement, also known as NEIC or Better Investing, and captured by interpretation at Manifest Investing. So as you see there, we will be expecting you to do your own homework, but we do this fairly powerful demonstrations of the stuff that we believe. Here's our standing agenda. Again, we'll talk a little bit about results, don't get too wrapped up in them, but we also will do some hot seat challenges for a couple of companies. We will give the Golden Knight annual rewards just a little bit of warning. We used to complain about Hugh McManus winning too many awards. Well, someone here tonight has taken care of that for us, and you'll see what I mean here in a minute. Then we'll move on to stock selections. Kim, Ken, Matt, and myself, and Cy will cover the stocks that you see there, the tickers on the screen. We will do an audience poll as we always do, and then we do, as Ken was saying, towards the end of the evening, we'll leave the floor open for questions and answers, either over the mics or through the questions tab. So I'm going to just go ahead and keep rolling, Ken. Again, welcome to our...
Okay, Mark, I'm going to interrupt you. We have a question, a hand raised from Leslie. Leslie, you're muted on your end, so I cannot unmute you. If you unmute yourself, you can speak to us. Leslie, she took the hand down, so it must have been inadvertent. So go on, Mark.
Okay, no problem. We do try to keep this fairly informal, and we'll try to keep on track, but we do entertain questions. One question that I thought we might cover here just briefly. At Manifest Investing, we run a stock selection contest from Groundhog Day to Groundhog Day, and we've been doing that now for 12 years. It actually predates the round table. And a question that we often get, where do some of these people come from? Well, what you're looking at here is a chart. It's kind of the Hall of Fame or All-Star chart for Groundhog participants. And what you see from left to right, again, you see a number of clubs. The clubs are all those with the parentheses and their geography that, the broad assets out of St. Louis is our first example. And then you see a couple of columns. The 2017 column is the value of $1 million Groundhog dollars invested a year ago as to what it was on this year's Groundhog. Our individual champion is Hugh McManus. He actually had an 83% return. We know that because the $1 million became $1,830,000 a year later. And the Sirius Investment Club is there. That's Nick Strategos. And just going down the list, you'll see a number of people that were on that cover slide, including Herb and the Northern Traders and Ken down at the bottom. But the thing that's important about this is the third and fourth columns over. That average return is actually the average annualized return for the people over the number of years, the far right hand column. So, for example, the broad assets have actually been participating in the groundhog for 6 years. Their average annual result is 36.7%. That actually beats the market over those 6 years by 21.7 percentage points. And that's just massive. I mean, and they do it year in and year out. We watch them. We try to learn from them. And one of these days, we'll probably have them at a round table in some shape or fashion. But from top to bottom, you can see that everybody on this list has actually outperformed the market over the period of participation. So again, it's a question we get, where do these people come from? Well, we notice people who seem to know what they're doing, and we try to get them to share some of their ideas. You're going to get a sense for some of that here tonight. Any questions on that, Ken?
No, we're moving along real well, Mark.
All right, just a reminder, we're just here to share. We're here to share what we think are fairly decent, actionable ideas. When we say actionable, we mean that's something you ought to study and kind of put through the gauntlet of a traditional stock study to decide whether it's worth it or not. We do keep track. We want to beat the market by 5 percentage points over the long term. We define the market as the Wilshire 5000, and we do want to see the majority of our selections actually outperform the market over the long term. All right, here's where Mark gets some humble pie. I actually made a mistake, and I'm just going to put this under the column of not all restatements are bad. There's bad news and there's good news. The bad news is I made mistakes. The good news is I forgot a bunch of transactions that actually raised our rate of return. We've actually been doing a lot of house cleaning during 2017. If you go back and look at all of the monthly roundtables, we've been selling a bunch of stocks. I missed a few of those transactions. And that actually raised our performance since inception up to 18.8% per year. And we actually are now, and have been for the last half year or so, beating the market by more than 5%. In fact, most of us, 60% of the participants of the roundtable nights and the guests that come here are actually beating the market over the long term. So some pretty good stuff. I'm sorry for making that mistake, but again, we sat down with the pizza and the adult beverages and the accountants and went over the list and did some cleaning up. And I guess if we got to have a restatement, this isn't such a bad one. Ken?
Mark, I'm going to interrupt with a question. Sharon would like to know, is there a place where she can see the picks for the roundtable for this year?
Well, we're going to show a little bit of that as we go through tonight. We don't actually display them anywhere. Every single roundtable is actually posted on the Manifest forum, and they're also posted at YouTube. So you can actually see them there. I mean, we can put out a list if that's what people want us to do.
Well, they can see the actual portfolios on YouTube, Mark?
Well, the actual selections that we make on a month-by-month basis. And then we also have, of course, the tracking portfolio, which we'll look at here in a few minutes.
Okay, I'm sorry. Sharon is correcting herself. She wants to know, can we see what the groundhog portfolios look like?
Oh yeah, we owe everybody a public link on that. We'll be publishing more on that in the next few days.
Okay, and we'll send that out to our list then. Mark will make sure that Natalie gets it, and next time Natalie sends you out a reminder, we'll include this information about where to find the roundtable stuff.
Any other questions? I mean, it is time for a cyber high five that we should have had a couple of months ago when we broke through that dotted red line is the goal that every modern investment club shoots for, to beat the market by 5%, and we finally actually made it to those levels. We've had such strong performance over the last year in a number of the positions that we have, and we're going to see that as we go through the awards. Anything else, Ken? Cy actually started to say something. Cy, did you have something on your mind?
I may have, but it has left my mind at this point. So carry on.
Okay, well, let's go ahead and punch through. Um, this is sort of what I was talking about with some. It's part of the answer to Sharon's question. These are the top 20 stocks by the size of the positions in the tracking portfolio. The tracking portfolio can be reviewed by anybody, whether you're a Manifest Investing subscriber or not, using that link up at the top of the page. The legend that appears below it is the number of times these stocks have been selected. So, for example, Cognizant Technology is now worth $25,672. If you go to that legend, it's been selected 12 times. So that every time that we make a decision, either an individual or the audience, and select a stock, we invest $1,000 into it. So $12,000 invested into Cognizant is now worth $25,672. So you can just kind of go down that list. I singled out NetEase down here because that's a one-time selection. $1,000 invested in NetEase is actually worth nearly $6,500 today. So that's a pretty substantial gain. And you'll see a number of community favorites and then a few that are just kind of a little bit off the radar screen. Any comments on any of the stocks from anybody on the team?
No, but I remember what I was about to say. We have to watch. We have to watch undercounting our results. I had a similar problem a couple of years ago with the growth stocks column for Better Investing magazine that I track. Mine, however, that's a managed portfolio, and I reinvest. And I was doing an inaccurate accounting for the market relative to the portfolio, and I restated and jumped up a percentage point or two. So
it's always good when they go that direction. The other direction is not quite as comfortable.
No, they're not as much fun.
All right, and I did circle S&P Global because that is a stock that's going to end up on the hot seat. It won't stay there long, but it'll be there. And just as a little bit of foreshadowing, I will tell you that Kim Butcher has actually picked PayPal, S&P Global, and LGI Homes, among probably a couple others on this list historically, so you can imagine what lies ahead here in the next few minutes. All right, here's a quick look at some of the stocks with the lowest return potential, classic hot seater challenge stocks. The average stock in our universe of about 2,400 stocks has a return forecast or a par of about 7%. And so we're just looking at some of the ones that have lower returns, those 5 at the bottom. Ken, any thoughts on the report card up in the upper right?
Well, I'm checking it out. I would like to see the par up around 11.5%, 12%. That's the lower end of the sweet spot, 5 above where the market average is. But, you know, in this market that is moving all around, 10% returns, if I can do 10% on a regular basis, I'm extremely happy with that. I'd also like to see the growth kicked up a little bit. We've been working on that by jettisoning some of our slower growing. And remember, this is sales growth that we're measuring, and it is a weighted average. We've been jettisoning some of our lower sales growth companies to try to boost this up. I think 6 or 8 months ago, this number was down around 9%. So we've been gradually moving it up. I think our target probably is somewhere around 11.5%, 12%. Everything else, though, looks pretty decent to me. Even the EPS stability at 70 in a personal portfolio, I would prefer that average to be maybe up closer to 80. But in a portfolio like this, where you have a couple of chances to do some speculation, I think this EPS of 70 is okay. I wouldn't give it an A, but it's a good solid B, I think, in the portfolio. Overall, we have some places that we know we'd like to see higher, but this is not a terrible report card for this portfolio.
No, and a lot of it is, and in fact, Kim, feel free to chime in. This is one of Kim's favorites, S&P Global, the old McGraw-Hill. It actually checks in with a fairly low return forecast, but keep in mind they just had an update in value line this week, and we'll cover that in a minute. But again, we'd like to see a little more growth and a little more par. And these are the type of companies that we will be challenging to make sure that we want to still hang on to them. So let's go ahead and end the mystery with S&P Global. When we actually factor in their expectations for 2018, 2019, and out in the 3 to 5 year forecast, we end up with a return forecast that's pretty close to the average stock. So I don't think we should be in any hurry to run for the exits on this one. Kim, would that align with your personal awareness of S&P Global? It's been awfully good to you.
Kim, you might be muted. We can't hear you if you're talking.
Oh, here I am. Can you hear me okay?
Yeah.
Yes, we can.
Okay. I am really thrilled how S&P Global has done, especially when we had that little 10% pullback. It went all the way down to 166, and it's already back up to 193. So I'm going to be patient in my portfolio and just reinvest my dividends as the dividends come in, and do that because usually at least once a year I recognize that S&P Global has a pullback, and that's when I kind of add to my portfolio and get more growth that way. So I'm personally just going to hold it in my portfolio.
Yeah, and it's got a lot of up, straight, and parallel characteristics, and it's taking shape pretty nicely. So unless it really goes out of the upside.
Well, and I really want to remind everyone that I really like spinoffs, and this is a spinoff stock.
Yep.
And these spinoff stocks, within the first year, they don't do much. The second year, if everything's working well, they start to explode in value, and that's what happened with PayPal, because last year PayPal was within 18 months from the spinoff, it returned 90%. So that's one of the reasons why I'm really kind of have started to skew my portfolio towards spinoff stocks.
Yeah, and I do want to make the distinction that S&P Global ends up on the hot seat. That's actually a good thing, because the stock price has been running up. So you can end up on the hot seat for all the right reasons, not because of weakening fundamentals, but because the stock price has been doing so well. So we'll just hang on to that one. The flip side of that coin is probably Caesarstone. This is one that's really one that we had hoped for much better from. And Ken, I'll let you spend some time talking about the types of things we're seeing as we go down this path.
Yeah, Mark and I are setting some triggers. We're trying to use the quality rating as yet another indicator that we might be ready to sell a stock, and we're looking for an indicator that gives us a couple of months, of forewarning to get out before it just crashes in price. I'm looking at the orange arrow that Mark put on this graph right here. This is called a chronicle, by the way, and it's at the bottom of every single one of the stocks that we cover in Manifest Investing. But on the chronicle, I see this abrupt lowering of quality from somewhere around 97 or 98 to somewhere below 70. It happened over a span of about 3 months. Well, not even where Mark drew that second small arrow, but where the third arrow comes down right before that flat spot right there. That's about 70, maybe even it's 68 or something. But I'm saying to myself, even if I didn't sell after that first drop in quality, maybe that second drop should have convinced me that there was something fundamentally wrong with what's going on in the company. And then look at the green bars after that third little tiny arrow that Mark drew on the picture right there. Look at the capital that I could have saved. And rather, what I chose to do, what this portfolio chose to do, was to stay the course. So watch the green bars over the next 2 or 3 years, and you can see that they're considerably below. And then finally, just recently, we take another huge dive in quality down to below 50%, maybe 47, 46, something like that in quality. And at that point, I've lost a lot of my capital. That price bar is less than half of what it was in that area of price bars that Mark circled after the first drop in quality. If we would have been on our toes and if we would have been using these triggers earlier, then we got a got a really, really clear sell out of Caesarstone. Even if we sold it after that first drop in quality, and then watched it go up past the price we sold it at a couple of times, I still think we would be happy 2.5, 3 years later when we see where the price has moved to at this place. So we're testing this trigger, and so far we've only found one test of the trigger that hasn't really followed through into the future. We do find that the dozen or so anecdotes that we've pulled out so far, this trigger has served us well. A high quality company, like it was when we purchased it, quality up near 100, and then dropping precipitously, in this case, to something probably around 67, 68. That should have been our signal to get rid of the stock. That's Caesarstone, and the next graph looks kind of the same.
Yeah, so again, I want to make the point that this is kind of one of those situations where in many cases you will have held on long enough that perhaps all the damage has been done. So, I think many of us may have noticed Fossil going from $5 a share to $15 a share here fairly recently. What we are attempting to identify is that plateau, that mesa, and actually identify stocks in the portfolio back in when they resemble conditions along this time frame. And again, as Ken has suggested, it looks like we have some time to make that identification and decision. And again, we're talking capital preservation, and if we sell, and I think we probably just go ahead and file Caesarstone away, and perhaps sell it even under the degraded conditions based on what we're seeing in this quality inflection at the far side of the graph. So
I agree.
I think Susan and I are the two people that have selected Caesarstone, so we'll take a contusion and hope to heal. All right, so let's go ahead, and we're going to go into an awards program. It'll actually be a bit abbreviated because it has a very common theme, and that common theme was the young lady at the upper left. So we said we were tired of Hugh McManus winning all the awards, so somebody stepped in and took care of that. The first award for tonight is the best selection for the calendar year 2017, and that's actually shared by Kim in the audience. LGI Homes was selected by Kim at the National Convention and then reselected again a couple weeks later when we did a repeat of the broadcast. And you can see that the audience and Kim actually did pretty well, coming in with a stock that actually more than doubled and beat the market by almost 90 percentage points. Those numbers are off the chart. Now, all those other numbers are often good enough to win in other years. EPAM Systems, a size proxy for Cognizant Technology, did pretty well. Ken's FleetCor, Gentex did pretty well. My Mercado Libre. Some of these stocks have actually stumbled a little bit in recent days, but those are some pretty good results. But Kim takes home, and the audience takes home the Golden Knight for best selection made during the last calendar year. So congratulations, Kim. So let's go ahead and talk about the best selection all time. And once again, it's Kim and the audience and LGI Homes. That selection that has done so well in the last year is actually our top performing selection since the inception of the roundtable. And you see some of the older picks that are going back a few years there. I will note that the closed or realized position in Stifel Financial, that one's not going to change. All the other numbers on this chart change daily, but that one's not going to change. It is locked in, so that's the best realized pick. That's mine back from 2016. And Hugh still owns the largest dollar volume gain in a stock. His $1,000 invested in Amazon is now worth almost $5,200. So again, some pretty staggering numbers. Much of that progress in gains happening in the last calendar year. So a whole lot of fun along the way. So again, congratulations, Kim and the audience, for 2 more Golden Knights. And then just to keep the theme current, the highest accuracy, that's stocks that actually outperform the market. Kim takes that home for 2017, and she also gets it for the all-time results. we're starting to run out of pictures, so we had to grab some old Berkshire Hathaway pictures there. Kim actually is the all-time leader now, nudging out Hugh. We do notice that Herb is still 4 for 4. We need to get Herb to pick some more stocks, so we'll have to invite him back, Ken, and get a few more stocks in there. He's literally batting 4 for 4 so far. So again, congratulations, Kim, on the annual accuracy and the all-time accuracy. So she's hogging the awards, and that noise you hear in the background is her building a bigger trophy case. All right, to take a break from the Kim Butcher Award Show, just want to point out that we do give kind of an honorary award to the Best Picture, People's Choice. Some of you that have been with us for a number of years will remember Ken talking about pulled pork, or Hugh McManus talking about cavemen and dinosaurs and Vulcans and campfires. Cy Lynch's talk about Teva, Across Oceans of Opportunity, the thing I did on Eddie Elfenbein's Crossing Wall Street. Matt Spielman did a fascinating stroll across the parking lot talking about the birth of Air Lease as a company. And then we did share a few of our favorite screens and our work on relatively better selling. This year we've got something a little bit different. We've actually picked some rhinos. The individual that I'm citing here, his name is Jim Bowen. He is Chief Executive Officer of First Trust, and this was actually brought to our attention by Joshua Reformed Broker Brown. And you can actually find this on YouTube if you search any of that stuff, but there's the link that's actually there. The reason that we're actually recognizing Jim Bowen and this presentation is because I've shared this with a number of people. Actually, I've sat through it with a few people. Everybody comments that it's strong. On social media, it received, every time somebody looked at it, I heard back from them about some aspect of this whole thing of challenging narratives and doing the math, and math wins. Jim actually walked through the stock market, the 2016 stock market, talked about Ebola, talked about the facts behind the staggering success that's actually being made in the realm of the cancer challenge. And he spent some time talking about a subject which I want to understand a little bit better. He talked about standing in his backyard in Elmhurst, Illinois, on New Year's Eve, shedding a tear. He actually said getting weepy about the TOT tanker leaving a port in Texas for some other part of the world for the first time in over 40 years. We actually had a full tanker leaving the United States going somewhere else. And the point that he makes with that presentation is that basically our energy situation is very powerfully positioned for the future. And he says that has tremendous ramifications for people going less hungry, et cetera, et cetera. Ken, did you have any thoughts on Mr. Bowen and
Mark,
his thoughts?
I was first exposed to this particular speech in the car riding with you. I don't know where we were going, maybe to Pennsylvania. But you put this on and you said, listen to this. And 15 or 18 minutes later, I think my whole thought process had been, first of all, reinforced. I always had a kind of a sneaking suspicion that some of the things that I heard on television were done for effect. They were hyperbole to the point where I couldn't really believe some of the facts and figures that were being attached to what was going on. And Mr. Bowen just reinforced for me the idea that math and facts wins over narrative and tweets and false facts and name calling and everything else. So I strongly urge those of you that have less than 20 minutes to pull up this YouTube speech and listen to him as he talks very simple English and lays out the facts about a lot of things that everybody thinks they know the answer to, and in fact the facts don't reinforce what the popular answer happens to be.
Yeah, and I mean he tries to avoid the political, but he does try to explain our current president. And whether you like him or not, there are certain things that he's doing that perhaps need to be understood. And there's just a whole number of things. He challenges the notion that the manufacturing is on decline in the United States, and goes through the facts and says it's really not. and here's what's actually happening. So again, it's provocative, but fact-based, and just a whole lot of fun. Very informative. All right, so that's our pick for that. So let's go ahead and finish off with the best director and best movie or best picture and end of the night awards. Here's for the best annual performance in a leading role. Who has the best or highest relative return for 2017? Again, when you're picking like she's been picking, LGI Homes, LCI Industries. She also had a pick of Novo Nordisk. There's actually one that's not shown on here. Her spinoff fund that she shared. It's one of the holdings in the tracking portfolio. By the time you stack all that stuff up, Kim takes home yet another trophy for best relative return for 2017. So congratulations, Kim, and again another picture from Omaha with the gecko. And we'll give her one last chance at the basket here. Best all-time performance. This goes back. This is since inception. The best relative return. And her actual absolute return checks in at about 22% for her selection since we started doing this, and actually beating the market by over 8%. So, Kim, do you have an acceptance speech or any comments to make? Or congratulations in a big way. Big cyber ovation headed your way.
I don't really know what to say. I feel like I'm just a student and trying to get it right. And I didn't realize I'd gotten so many right. I just keep trying to do the same thing and trying to be consistent and the same methodology. And I have to admit that I've made myself a checklist on things, and it seems to have improved my results. I didn't realize this much, but yeah.
Well, we just hope that you'll keep sharing. And again, if you need some help with that trophy space, either in Indiana or Florida, I'm sure we can stop by and help you out.
You're welcome anytime.
All right. So with that, we're going to go.
Mark, excuse me. I'm getting a message from Tom, and he says he went to the YouTube site that you messaged, and it said this video is unavailable. Can you check that out this evening and then maybe send an email to Tom? Tom, will you send a personal email to mark@manifestinvesting.com, and he'll respond to you tomorrow with where you can find that video. Anybody else that is having trouble finding that video, would you do the same? Send an email to mark@manifestinvesting.com, and he will locate that and go on there. And
Absolutely.
find it for you.
I checked the link, so it was okay a couple days ago. Sometimes the traffic triggers them to do things. It's available in a couple of different ways out there. Anything else, Ken?
Mark, Debbie has told us that if you search for the name Jim Bowen, you can find the video. Jim Bowen, B-O-W-E-N. If you search YouTube for that name, Debbie says the video does come up.
Okay, and
so we're getting a lot of folks. That are telling us the link works, and we're also getting a lot of folks that says the search works. So try that before you bother Mark, okay?
Yeah, I'll add that to the comments that are in the forum and in the social media that we post, and I'll double check the link also.
Okay, and then I have two messages from two of you out there that says you can't see anything on your screen. If you've called in on the phone, then you're only getting audio. You must sign in so that you can get the computer to see what our computers are showing. That's the only possibility that I can think of why you can hear the audio, but you can't see the screen. If that doesn't help, then I would suggest that you might try a call to GoToMeeting service. And for the next time, that might help a little bit, okay? Ross has my name typed with a colon, and then Ross, I assume you're going to ask a question, so I'm waiting with bated breath for what the question is. If you're just saying hi back, Ross, okay?
I think he's smiling at you.
Could be.
Okay, and keep in mind that we do make links to the YouTube version of this, and we provide the slides in a PDF after the event, so you'll have that also. So with
Okay,
that,
Mark, I'm going to interrupt again.
okay.
I have 3 of you wanting to be reminded about this program. What you need to do is send an email to N Kavula, Nkavula, the number 1, at Comcast.net. That's Nkavula1 at Comcast.net. And all the email has to say is, please add me to the roundtable list, and it will be done. Thank you.
Okay, well, I show about 9 o'clock, so we have about a half hour or so. If we can go into our presentations for 6 to 8 minutes or whatever, I won't need that much, and we certainly don't need that much for Matt, so we'll just try to keep
And
rolling.
we're going to remind all 5 of us to try to keep these under 5 or 6 minutes if you possibly can, okay?
Yep. So with that, let's go ahead and have Kim kick off with Sirius XM.
Well, yeah, I'm going to present Sirius XM radio today. If you own a car that has the possibility of Sirius radio, I like the stock also because it is one of those fabulous terms to an investor, reoccurring revenue. Every month people pay for the radio to work and they can find all the channels they want. Next slide. This is what the financial highlights were from their last quarter results. Revenue was up 8%. Subscribers increased another 4%. They had share buybacks of $1.4 billion, and they've authorized another $2 billion, and I think it's gone up since then. The dividend has increased, and for 2018, they have issued guidance of adding another 1 million subscribers, getting revenue to be $5.7 billion, and free cash flow up to $1.5 billion. Next slide. Their highlights include and I didn't even realize this until I looked at the stock. I just thought of Sirius Radio as being the radio and you listen to music, but they've now got more genres in there. They've got a Beatles channel, they've got rock, they've got contracts that they just gotten signed with college sports, with ESPN, CBS Sports, and also comedy. They're getting a whole different venues besides just Howard Stern to get people interested in having the radio and let them provide the radio to you. Next slide. And this is what they talked about for what they had, how they had reported out, if you couldn't quite see all that. So they've done really well. They really don't talk about, the SSG talks about earnings. Sirius Radio talks about more free cash flow. And so they've done quite well with how they've been able to generate lots of free cash. So they do have a bit more debt on the balance sheet than what we're really used to as BI members. Next slide. Their guidance is how much they can't plan on keep growing, and they give guidance according to free cash flow, as I said. Next slide. As I was saying, they've got NBA basketball, they've got hockey games, they've got PGA, and they've all got it at different price points. So it's giving a wide variety to everybody. They also, in this last quarter, they bought a certain percentage of Pandora Radio. So they're diversifying in that way also. Next slide. Now, if you may recall, when we had George Nicholson talked about the triple play, and you want to have operating margins that are consistent or increasing, the PE is lower than the forecasted, and the stock price has room for capital appreciation. And we're going to go through and show how Sirius Radio right now is a triple play as well, and I'll show you some of the other things on a value line, on my value line, that I like to look at to make me interested in a stock. Next slide. Okay, Mark, I'm going to have you circle over in the projections box for me. I will not be interested in a stock unless my low return is at least 10%. And you can see here it's 21% on the low end and 38% on the high end. Currently, the stock price today closed at $6.29. So if you would see at $6.29, if it reaches the low price of $12 in 5 years, we've got a double. If it gets to $20, that could be a triple. Notice our PE here. Our PE when the stock price was $568 was 21.8, but look at what the trailing and the median is. That is definitely below that. That's one of my checklist items that I look at very carefully. Also, in the middle of the screen, you have the solid line and the dotted line, and notice where the stock price is below the solid and the dotted line. That says that, for me, that shows that the stock price is undervalued. And where you see the dotted lines on the far right-hand side at the $12 and the $20, that's the space there where Value Line feels that the stock price is going to go. So you can see how much that stock price can go up. Now, Value Line does their evaluation on a stock and gives us our reports by cash flow. So next slide, please. This is the middle of the Value Line sheet, and some of these things that I look at on my personal checklist is I want to see consistency and I want to see that we have growth. As you can see how the revenues have been going up, if you just look at the last 5 years from 65 cents, and in 2017 it was $1.20. So that's, you're getting your double there. Cash flow is going from 14 cents to 25 cents. There's another double. If you're looking at what your capital spending is, I like it very consistently I like a cash generating company, not a cash consuming. Look at how little cash they have to spend per share. It goes from 2 cents to 5 cents. That's very little. So we don't have a very capital intensive company, which is wonderful. Look at your book value. Buffett and Berkshire Hathaway says that judge them and that stock by their book value. Well, it's gone from, in 2012 it was 77 cents, and now they've added a dividend. That's what those small D's are, but it's supposed to go up to $1.10. Our share count has steadily been going downhill, and I always want to remind people, you want to make sure the share count is consistent or going down, not going up, because if you got that strawberry pie in the kitchen, you don't want to have to cut it into more slices. You want that big piece of pie just for yourself. You can see where the annual PE and how they think that's going to go. They say projecting out it's at 32, but in 2015 it was 43, so it's going down, and it's kind of in that consistent. It's a little bit higher, but we're hoping that we're going to have some price appreciation, so we'll have some PE appreciation. We've already talked about revenues, and if you want to also look at the net profit, our operating margin is 50%. Well, I'm greedy, that's wonderful, and our net profit margin is almost at 29-30%. Really good. Yes, we have a lot of debt at $6 billion, but we have lots of free cash flow that can help pay that down. And yes, we have a low interest rate environment right now, but as they generate more and more free cash flow, they'll easily be able to pay down their debt. I love it when you have a stock that has great management, that are great capital allocators. So the money they invest in the company, I want to make sure that they get good returns with it. That's your return on total capital. I have a minimum of 15%, just like we want 15% growth with our stocks. Well, this stock and this management team has a return on total capital of 26.5%. Outstanding. The other thing I will look over here on the left-hand side in the small box, I like it that this company has no defined pension plan issues, so I won't have to worry about any issues with that. Next slide. One of the things I'm going to circle right in here is in the middle of the box where it says business. You can see where Liberty Media owns 67.21% of Sirius Radio. And I don't know how many of you know this, but Liberty Media is the company that is managed and began by John Malone. John Malone is understood to be one of the greatest capital allocators. And Greg Mahaffey, who's the CEO here, is one of his students underneath him, and he came from GE. I love to look at where in the middle of the box it says these shares are ranked to outperform the broader market averages in the year ahead. So holds wide capital appreciation potential out to 2020, 2022. And they've hiked the dividend. I can't find anything wrong. Next slide. I do what I call a quick and dirty DCF from the value line sheet. You take the legends box, which you have here, which is 25 times the cash flow per share, and you say, and from the graph in the middle of the page, you had a 55-cent cash flow per share that was projected out to 2022, minus 5 cents of a dividend per share, minus 5 cents of capital spendings per share gives us 45 cents. 45 cents times that 25 of cash flow per share equals the stock price, which should be up to $11.25. Now you compare that to what the 2022 projections are of a low of $12 of a stock price versus $11.25. We're real close to that by cash flow of what this stock price could do. And if you take a stock price currently at today at $6.29, you multiply that times 2, that would be $12.30, and that's giving us some pretty great capital appreciation. So this is a stock I'm presenting tonight for you to consider as something to add to your portfolio.
Thanks, Kim.
Thank you.
A little bit on the less conventional side, but again, I would point out that Kim and Hugh make some less traditional selections from time to time, and they seem to work out pretty well, more often than not. So with that, we'll go with Ken Kabula and his selection tonight of Healthcare Services Group. I will confess that I was already looking at this one when he decided to steal it from me a couple days ago. And my interest was in the dramatic steadiness of that stock price chart that you're looking at on your screen right there. So Ken, go ahead, complete your stealing and walk away with my idea.
Okay. I'll tell you that the Wolves Investment Club, the club that I've been active in for about 25 years now, the Wolves Club has owned this stock for a dozen or more years, and we've added to the position whenever the stock has shown a reasonable tendency to be a buy. But if you notice from the RSI graph at the very top of this set of graphs, you'll notice that it pokes above that 70 RSI on a fairly regular basis. And we've never sold Healthcare Services Group. It just keeps making us money, but it hardly ever becomes something that we would consider a buy as well. So we're dealing with 2 or 3 positions that we bought quite a while ago. It's made us a lot of money, and it holds an average, a little bit bigger than average position in our portfolio. That blue line is stunning for how straight it is on the price graph. That's a moving average, and you can see the price bars. While it does, oscillate a little bit, for the most part, that's just going up straight as you possibly can. Next slide, Mark. Here's the logo for the company. Next slide. It has virtually a very small market penetration because the company operates in an area where there's a lot of very small players and a lot of fragmentation. The company does housekeeping and laundry things for hospitals, about 3% of the total business that's available. It does long-term and acute care housekeeping and laundry costs for about 6% of the money that's available. So huge amounts of the place to delve into and to add to the business. Notice the penetration in the dining and nutrition is about 6% for hospitals and 12% for long-term and post-acute care. Contracted management in hospitals for these types of services is at about 28%, and in long-term and post-acute care, contracted management is less than 5%. So Healthcare Services Group, which basically does cleaning and offers dining services for hospitals, long-term and post-acute care facilities, is a large player in an extremely fragmented business. Next slide. It's the largest, one of the largest housekeeping and laundry, dining and nutrition services, 38,000 facilities under management. But here's the fact that I like the best about this company. No matter who you read, no matter which of the sources you read about this company, they make a point that 90 to 95% of their business is under retention and under contract. So they know their income stream for 90 to 95% of their business when they start the new year, and all they're worried about then is adding to the pool to get the growth that they're looking for. It's a steady, recurring revenue stream for a very low capital-intensive business. Next slide. You can see that they operate all over the country with a concentration in the Northeast and the South. They are moving aggressively, however, into anywhere where there isn't a blue dot right now and where people live. So you can expect the growth to continue, especially as private or single ownership hospitals and long-term and acute care facilities join networks or enter into national contracts with management groups. Next slide. Their business is split almost evenly, 50-50, with dining and nutrition providing much, 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 much higher margins than housekeeping and laundry. Next slide. They're going to grow by expanding geographically. They're going to grow by their ties to national chains, which keep growing. They plan on selling their housekeeping and laundry services to clients that only deal with dining and nutrition, and vice versa. They plan to sell their dining and nutrition services to people that only deal with housekeeping and laundry. In other words, they'd like all of their contracts to be for both segments of their business. Next slide. This is the Chronicle. You can see that blue quality line is consistent at somewhere between 75 and 80. I like that nice consistent quality. That red line is par, and tomorrow's the end of the month. So tomorrow's par value is going to add on this graph, and if it holds anywhere near where it is right now, that par value is going to be where Mark just drew it, up around 12%, give or take a little bit. So the par value tonight, sitting tonight, is near historic highs. You follow that back to the left, and you'll see there's only been a couple of times in the last 4 or 5 years when the par has been as high as it is right now, and that makes for a buying opportunity. Next slide. Value Line likes to see revenues growing at about 10 to 11%. That number seems to be pretty consistent through all the sources that I've read. Earnings, Value Line's a little bit more aggressive on the earnings call at about 16.5%. I've seen numbers that go 14 to about 17, with Value Line again being on the high end. This company pays a nice dividend, a better than 1.5% dividend. That's something you don't often find in a fairly small company. company, so I'm getting a very nice dividend. Because the company has such low capital intensity, there's a lot of speculation that that dividend will rise as the 34-35% tax rate moves down into the low 20s somewhere. I like to see the last paragraph on a value line report. The stock is richly valued, but we see enough upside ahead to support good capital appreciation out for the next 3 or 5 years. That's the same conclusion I have. Richly valued, and you're going to see that in a moment, but if you assume those rich valuations to hold as they have for the last 7 or 8 years, then you're going to get good capital appreciation. Next slide. Here's the data from Morningstar, and some of you might gulp at what happened in 2014. Without going into a huge amount of detail, I will tell you that in 2014, the company decided to self-insure. They've been a very successful self-insurer. There was a one-time charge in 2014 to set up their self-insurance program, and if you would take away that one-time charge, that blue line would be relatively parallel to that green line right there. When I do what I consider to be a conservative SSG, I get about a 12% annualized rate of return as par. Notice that 3% of that is coming from the dividend, and that's a great thing to have happening with a small to medium-sized stock. Next click, next slide, and that's all I have to say. So I would suggest that we look at, Mark, there's one of my slides missing here. It's the slide that has the manifest numbers at the bottom. Can you back up a couple slides and see if we just, there it is right there, I forgot it. Notice down at the bottom that Manifest is making a call, a 95 quality with a par of also around 12%. So my SSG is sitting at almost exactly the same place that Manifest is. That gives me some validity. It makes me feel that I've verified the information correctly, and it gives me some confidence in what I'm doing. So I'm going to suggest we add a brand new stock to the portfolio, Healthcare Services Group, HCSG.
Well, thanks, Ken. I'm actually surprised that one's not in here yet, because it's been such a well-managed company, and there have been, as shown in the chart up above, there have been buying opportunities. So maybe we'll watch and catch another one here pretty soon to accumulate. All right, I'm going to do a 1-minute commercial here. Matt was going to try to join us tonight, Matt Spielman. He's one of the directors in the Mid-Michigan chapter, works a lot with Ken and myself, and he's been a guest night on a number of occasions. One of the things that Matt does an exemplary job of is following a few fairly interesting companies. We mentioned Air Lease earlier in the awards session, and Camping World is another one that he's actually followed from the time when the prophet Marcus got involved, and he follows it through the transactions with Gander Mountain or whatever. So you can see this is actually a developing story, and he follows it very closely. So if you have an interest in following this company, he follows a few companies like this. I don't think you can find a better stock watcher to be on your team, and he does it as a volunteer in the Manifest Forum, and basically watches this thing like a hawk, right down to the posts and the tweets that Marcus puts on Twitter. So we're going to add it to the tracking portfolio. You can see that it has a return in the 13-14% range. Again, very early, watching the build out of this story. And if Marcus can pull off the transformation of this company, it's an area with a rather vast field of opportunity, and it'll be kind of interesting to watch. So we'll add that on behalf of Matt. All right, we're going to switch to mine, and I actually did a fairly quick screen looking for companies with great long-term perspectives in terms of a decent return forecast and a fairly high quality ranking. You can see that here, fairly high return forecast, fairly decent quality. And then I overlaid them with something I don't do very often, but I basically went out there looking for companies that are oversold. And Ken talked about the RSI being above 70. They're oversold at the other end when they're actually below 30. So I'm actually trying to shop down around the companies, see if there's anything that's interesting in we'll go as high as 40 or less. And during the time I was doing the update, the news hit on General Electric restating earnings. In fact, one of these months we're going to have Hugh show up and talk about his 5-time selection of GE. He and I have had sidebar discussions that were greatly disturbed by some of the stuff that they've been doing and their method of recognizing revenue, and they're under investigation, and all that stuff is added up to finally a hit on the financial rating of the company. And we've seen the quality rating go down a little bit in recent days, and the forecast prices for General Electric are actually under assault also. Same thing is kind of true of Stericycle. They came in with results that were a little bit weak in the fourth quarter, and I think the market's probably overreacted, but I would set either one of the two of them aside. And I'm going to go ahead and go with Prestige Brands. I'm surprised that I didn't pick this one a few months ago. Thought I had. Prestige Brands is the spick and span company. They also have a few of those products that you all know and love, from Clear Eyes to Comet, down at the bottom of the screen. But I'm looking at a company that's got an elevated return forecast, an excellent quality rating, ranked in the top 1% of all companies at Manifest, possibly oversold. This position is that position between the 52-week low and the 52-week target high price, so we want to see something down in the 0 to 20 range. It qualifies there. Morningstar thinks it's on sale at 77. The current price is 77% of the fair value as calculated by Morningstar. If I have one thing that I worry about, S&P thinks this thing is dramatically underpriced, and that opinion is probably going to change. And when it does, that'll probably cause a disruption in the stock price of Prestige Brands if it hasn't already been accounted for. And then for the year ahead, both from the analyst consensus and from S&P, fairly staggering numbers to the upside. So again, it looks like the deck might be stacked in the favor of this company. Again, just as a quick reminder of the conditions that it's facing, and just a reminder of the products involved here, from oral care to ears and nose and throat, and we've just been through cold season, Dramamine, but probably most spectacularly, they own Spick and Span and Comet. And I was just standing in the Home Depot the other night looking down there's an entire aisle full of their stuff, and many of these brands, including Chloraseptic and Ludens, are on here also. So this is a company that, if you're not aware, they actually have all of these in their fairly highly regarded and well-performing product portfolio. Here's a quick look at the company. The visual analysis from the business model is strong, nearly up, straight, and parallel. Pretty nice looking company as the years have gone by. They're managing their portfolio to get ever improving profitability picture down here. Again, that's kind of like section 2A of your stock selection guide. A steadily improving situation that seems to be doing okay. The stock price has been down a little bit in the last year or so. That's accounted for in the last year and in the year ahead in the PE ratio. But just looking at a company that has, again, basically low double-digit growth. I used 9%, decent profit margins based on this picture down below, and then a PE ratio that's actually a little bit less than most analysts think at 16. We're still talking about a return forecast in the mid-teens, and I'm very comfortable with a company like this that has seemingly gone on sale. I do not see the wheels coming off in any highly visible fashion, so we'll take a run with Prestige Brands in the portfolio and hope for good days ahead, good spick and span moments. So with that, I'll turn it over to Cy for our fifth and final stock for the evening, McKesson. It's a repeat selection from a few months ago. Go ahead, Cy.
All right, thank you, Mark. I was close to Prestige Brands too. The biggest thing that held me back is you know how closely I watch financial strength, especially in rising or peaking potential markets, and I don't know why, but it's Manifest has it down around 35. I know it's not a widely followed company, so I don't know where, if you just got one rating in your analyst and that one kind of beat them up. But anyway, it looks like a very strong company.
I'll take a look
for
at
all
that.
the reasons you just mentioned, but the financial strength was my biggest concern. But record-wise, it looks super. So that could even be an error, perhaps. But my pick tonight, that I did decide to kind of stay in the healthcare. We've actually had three aspects of healthcare, I guess, tonight from Ken, and then Mark's pick, and now McKesson is mine tonight. As you can see, up straight and parallel. Go ahead to the next slide. This is a summary slide of what the company does. It's the ranked fifth on the Fortune 500 companies. So that's why it calls itself a Fortune 5 company. When I first saw that, I wasn't exactly sure what they meant. But McKesson is primarily a pharmaceutical distributor. They're one of the three largest, in fact, one of the three primary pharmaceutical distributors with Cardinal Health and AmeriSource that we'll see in the next slide. And this just gives you a quick summary. They deliver 1/3 of all prescription medicine in the country. They actually, you notice they talk about 15,000 owned and banner pharmacies. They actually own small local pharmacies and are in fact the fourth largest pharmacy in the country, of course, well behind the really big names, but that's what they do. And then they also have divisions that provide back office technology support for primarily non-hospital health providers, doctors, surgery clinics, and that sort of thing. Next slide. Again, distribution is the key to McKesson, and it's the core of their business. And notice CVS mail order and Walmart pharmacies are among their major clients. I believe, let's see, I'll flip over to a note that I had. They also supply, of course, distribute to hospitals as major clients. And okay, now I found my note. 76% of hospitals with 200 plus beds are clients, as well as 24 of the top 25 health plans. So in addition, of course, to CVS, many other health plans also use McKesson services. Next slide, please. Did a mini industry study, and here are the medical supply distributors. McKesson, Cardinal Health, and AmeriSource have about 90% of the pharmaceutical distribution. Owens & Minor does that, as well as some other medical supplies, which also McKesson does medical supplies beyond just pharmaceuticals. Notice it's the highest par in the industry, but also quality factors. It's the highest quality, highest financial strength, and right in line with the highest growth with AmeriSource. So it's not a super fast-growing company. It's certainly a mature growing company, but in its industry, it's very solid. Next slide. And then here's my Eagle for the three judgments. And the bottom line, I used a sales growth projection of about 7%, which is consistent with the last few years. It's a little below the 10-year average. I think that's slightly above Manifest consensus figures. Net margin, notice the margins in this business are extremely small, but that's my projection going forward. There was an odd extraordinary charge back in the last quarter, I believe, of 2016 that is throwing that historical margin there on manifest's number off. I believe that's why it's only 0. But that's the 1.1% is in line with current margin. Value Line and some others expect the margins to expand, but I'm leaving it about the same. Then PE forecast, again, you notice there's a calculation mathematical issue with the current PE, but that's in line with historical averages. I think that is the median for the last 10 years, if I recall, that I'm using as my PE forecast, and it gives me a good right at 13%, 12.9%, which again is in line with the manifest consensus figures for that as well. I'm a little more optimistic on PE, a little less optimistic on margin and sales, but we end up coming out to about the same place in the bottom line. So I'm saying let's double down on McKesson.
Okay, thank you, Si. Ken, why don't you go ahead and strum up a poll for us?
Give me just a second here, if you would. And the poll is launched. All you have to do is take your mouse and choose one of the stocks that have been presented.
And even if you're joining us for the first time, you are certainly welcome. We welcome all voting. Anyone from the Chicago area is welcome to vote multiple times.
I like to hold on until we get about 80% voting. We're up to 85, so I'm going to count to 10 in my mind. 88% voting, 89% voting. And we just hit 90, and I'm going to close the poll. And I'm going to share the results. And it looks like we're going to add a second position in Sirius. Healthcare second, Prestige third, McKesson fourth, and Camping World in fifth place. So let's add 2 positions in Sirius to the tracking portfolio. I'm going to hide the poll now, and we should go back to the presentation now. Mark, if you want to advance one more slide.
And the audience loves a winner. They're going with Kim Butcher, and I don't blame them.
So here we are looking at our coming attractions, folks. These are places where Mark and me, or just Mark, or just me, will be presenting in the next couple of months. Si also, Kim in a couple of these as well. We'll start by Bridgeport, Michigan's Saturday session on March 10th. If you want more information on that, drop me an email. We'll save you a space. It's free. Mark and I will be in St. Louis on March 17th. We'll be at the March Roundtable, this same program, on March 27th. Turnout Tuesday is coming up April 3rd, about a month from now. Mark and I will be in Cincinnati on April 21st, actually north of Cincinnati, between Cincinnati and Dayton. We'll be presenting at a Southeastern Michigan program on April 28th in Ann Arbor. The convention where you'll see Kim and Si and myself and Nick and a couple of the other Knights of the Round Table will be there as well. That's in Orlando, May 17th through 20th. I'm going to be by myself in the heart of Oklahoma in August, and Mark will be presenting in Atlanta in August. 2 great places to be in August, right? Oklahoma and Georgia.
Yes, Si will be there too.
Si will be at the Atlanta Investing Day as well. That's Si's hometown. So if you have a chance to come see us and spend the day and chat a little bit, we'd love to have you at any of these events. Again, for those of you that are in mid-Michigan, if you'd like to come to the Bridgeport session, drop me an email in the next couple of days and we'll save you a seat. It is a free program, but we do require pre-registration. Thank you.
And I'll just close with reinforcing that it is Happy Groundhog Month. We don't do just a day here at Manifest Investing. We do a whole month. But I also wanted to point out that traditionally George Nicholson used to use the month of February to remind people that to attempt to try to influence friends and family to experience the wonders of successful investing, and would encourage any and all of you for not just February and not just March, but to consciously watch for an opportunity to show somebody, let them experience what we do, because it's kind of a fascinating thing, and it shouldn't be the well-kept secret that it is when I see the difference it can make in many people's lives. So again, invite a friend to some of the stuff that you've seen talked about here, and help them experience it.
Mark, I want to add a comment to something that I listened to today at the hearings. The brand new head of the Federal Reserve was at a hearing before the House, some of the people from the House of Representatives. And time after time, I heard that only 20 or 30% of the U.S. population invested in the stock market. It was only for the rich. I think it behooves all of us when we hear that fact to remind anybody that's spouting it that anybody with a 401k or anybody in any kind of a retirement plan, chances are astronomical that they're part of the American stock market. And for my facts, as I see them, that has to be more than 20 or 30% of the total population. So before you just write off the people that own stocks as being a bunch of rich folks, I think we need to make the point that there's a huge portion of our country involved in the American stock market, and they're involved through their 401k plans and through their retirement plans, through their IRAs. So I just wanted to get that off my, it's a soapbox moment for me.
I think Si might have an amen for you, Ken.
Say something about it, you know. Yes. Go ahead, Si.
Yeah, I was going to say something that I have discovered, Ken, and this really jumps on Mark's bandwagon a little bit on inviting a friend. Those of us who know or have influence over people who are younger, and I'm talking about certainly under 30, but perhaps even 35 to 40 and younger, but especially the under 30 crowd. Think of when they have grown up into adulthood. It's since the Great Recession. They have a very negative, or I don't want to say all of them, but I am astounded at the number, and talking to a few of them and then realizing where they have where they entered adulthood. I now understand why they do. But they've been hearing things like what Ken was just saying about the market is only for the rich. Of course, they have lived through the Great Recession. They're struggling or have struggled economically in many ways, and they tend to buy into, because again, we have very siloed information systems now, and I have run into quite a few that have a very negative view of our stock market system. And when I sit down and say, hey, let's talk for a few minutes. Yes, there's corruption in various places and so forth, but let's talk about what really the stock market actually is, and simply owning companies and talk them through. You can open a lot of eyes. And I'll be honest, I just had not completely realized how many people have such a skewed view of our stock market system, and it's largely because of things they hear on the media, and as I said, the time they've lived through. They've lived through a very tough time to come of age if you did not learn the stock market the way we have been blessed to.
Thanks for those thoughts, Si. They're appreciated. Anybody else have anything to add before we close this down? There's been a number of questions, but I've been listening to the presentation, and the questions seem to have been mostly answered at this point. If you did not get your question answered, maybe you can either drop an email to myself or to Mark. My email address is kcavula1 at Comcast.net, and Mark's is mark@manifestinvesting.com. So take a moment if you still have a question, and we'll try to get those answered offline. We'd like to thank everybody for coming this evening. Mark, we should shut down, and then I have a couple of questions to get answered after we shut down, okay?
Okay.